When you're trading live in the market, you often draw fair value gaps on the chart based on smart money concepts, and you wait for the price to come back to your entry point so you can take a trade. But many times, price moves away before reaching your entry level. Or sometimes it even dips below your entry zone and then shoots upward aggressively. Again, I believe most traders have faced this exact situation in their trading journey. But have you ever stopped and asked yourself why this happens to you, or why price reacts this way? To understand the answer, you not only need fair value gaps, you also need to understand one of the most important smart money concepts: imbalance. Knowing this core concept is extremely important. So in today's video, we're going to understand what an imbalance actually is and how you can use it to plan your trade entries more effectively. So let's start with the basics. What do we mean by imbalance? Most of the time, when the market moves from one area to another, it moves in a balanced structure, creating higher highs and higher lows, which shows equal strength between buyers and sellers. But when buyers become stronger at a specific point and sellers are fewer in comparison, the chart prints large bullish candles and the price moves upward very quickly. Sometimes you even see a visible gap between two candles. To understand this more easily, look at this table. On the left side, you can see buyer volume, and on the right side, you can see seller volume. You can clearly notice that buyers are placing far more buy orders than sellers at this level. This means the market is not in balance. Because of this imbalance, buying pressure increases and price shoots upward aggressively. This imbalance between buyers and sellers is what we call price imbalance. And on the chart, it appears in the form of candles. For example, in the chart on the left, while price is moving upward, some candles are touching the highs of the previous candles, but in many places, the next candle starts below the previous candle's high and moves sharply upward. Both of these situations are examples of market imbalance. At this point, buyers are still stronger than sellers, but the difference between them is not very large. However, the moment buyers become significantly stronger compared to sellers, the price starts pushing upward in a one-sided move. This clearly shows who is gaining dominance in the market. And if you reverse this same situation, you get a bearish imbalance. Now, when you are trading live, you obviously cannot keep checking buyer and seller numbers manually every time through tools like the option chain. If you try doing that, you might end up missing a very good trade entry. That's why, while reading the chart, you must stay focused and observe the candles carefully. As you read the chart, you should always ask yourself a few questions. How are the candles forming? What is their size? Are the candles stacking on top of each other? Or is there a visible gap between two candles? If you read the chart this way, chart reading becomes much easier, because candles are the only elements that reveal what buyers and sellers are doing in real time. By now, with these simple explanations, you should clearly understand what a price imbalance actually means. But if you still have any doubts, feel free to ask in the comments. I'll do my best to respond. Now let's move forward in the video and learn how to use this price imbalance to plan your trade entries. Whenever a gap forms between two candles, we call it a price imbalance or even a fair value gap. Whenever a price imbalance appears on the chart, the market has a higher probability of returning to that area to fill the gap. This is why we wait for price to come back before taking an entry, so we can position ourselves for a high-quality trade in that direction. But the question is, does every imbalance formed on the chart give us a reliable entry? The answer is no. For example, in this chart, as the market moves upward, you can see many imbalances forming between two candles. But if we want to take a long trade in alignment with the trend, we first need to understand which imbalance areas can provide the best risk-to-reward entry. To do that, we must divide this price move into premium areas and discount areas. To divide the move into premium and discount zones, we draw a line from the swing low to the swing high, and the area above the 50% level becomes the premium zone, while the area below 50% becomes the discount zone. To make this even easier, you can also use the Fibonacci tool. If you place the Fibonacci levels from the lower point of this move all the way up to the higher point, you'll get the 0.5 level. Everything above 0.5 is premium, and everything below 0.5 is discount. In the market, sellers prefer to enter positions in the premium zone, and buyers prefer entering in the discount zone where prices are cheaper. So in this situation, if you try to buy from the first imbalance area, your chances of success are very low, because there is no support level nearby to place a logical stop loss. This forces you to place a very large stop loss compared to your target, and that never fits into a good risk-to-reward ratio. Also, buyers who entered from lower levels are already sitting in profit, so even a small correction can trigger profit booking. When they book profits, buying pressure decreases. On top of that, markets often create fake breakouts to trap inexperienced retail buyers. Price pushes up just enough to attract emotional entries, and then drops quickly to hit their stop-loss levels. That's why you should avoid entering trades in this kind of imbalance area. But look at the imbalance area below it. Right under that zone, you can clearly see a support area. Price has taken support here before and moved upward from this level, and this imbalance is forming inside the discount zone. So buyers who missed the earlier long entry will likely attempt to enter here. Also, your stop loss will be placed near the support area, which keeps the stop loss small. And because the profit target is larger than the stop loss distance, your risk-to-reward ratio becomes excellent. This gives you the opportunity to take a low-risk trade with a small stop loss and a large potential target. That's why the first imbalance area creates a high-risk, low-reward entry, while the lower imbalance zone offers a low-risk, high-reward opportunity. Just like the first imbalance gave you a high-risk, low-reward entry, the second imbalance area gives you a low-risk, high-reward entry. That's why waiting for price to reach the right area is extremely important. Many traders might ask, if we keep waiting for the perfect entry, won't we miss many trade opportunities? But you must understand one thing. Trading is a business, and you must treat it like a business. Your goal is not to enter and exit trades for entertainment. Your job is to stay focused and follow your rules. That's what creates long-term profitability. Now let's learn a few secret tricks for entering trades in imbalance zones. Trick number 1, when price enters the imbalance area and forms a bullish candlestick pattern, you can take a long entry from that zone. Trick number 2, if price touches the imbalance area only once and reverses immediately, the chances of profit are very high. For example, if one candle forms a long lower wick inside the imbalance and closes above it, and the next candle pushes even higher, this becomes a high probability setup. But if the first candle closes outside the imbalance zone, and the next candle also stays outside before re-entering the area, that becomes a low probability setup where the chances of getting trapped are higher. In this situation, you should avoid entering until price clearly breaks out of the imbalance area again. Trick number 3, if the market is in an uptrend, look to enter long trades near imbalance zones that form inside the discount area. And if the market is in a downtrend, look for short entries around imbalance zones forming in the premium area. This will increase your win rate and protect you from overtrading. If you enjoyed this video, make sure to like it and subscribe to the channel. In the next video, we will explore another topic in detail. Thank you for watching.